Okay, guys, we're going to look at the 2000 cash budget, which is from a long time ago, but it is a question, and it came up again in 2002. It is a question which, even though it hasn't been asked in a long time, contains some elements that are good to know in cash budgeting in case a curveball is thrown in a more recent question. So, when you look at the question from the year 2000 on your exam packs, your question packs, or on examinations.ie, you'll get the exam. It says J. Rourke had the following assets and liabilities at the start of the year in 1999, with opening stock, debtors, cash, rent prepaid, capital as a liability. That's reminiscent of what we did at ordinary level. And then it says that the sales are expected to be for the next 7 months, from January through to July. They're expected to be the following numbers. Now, interestingly, if you actually go down to part A of the question, then it'll tell you that you're only required to do the cash budget for 6 months. So why do you need July at all as a seventh month? Well, we'll see that when we get into the question. I'm going to go through some of the skills which we already have learned reasonably quickly here, but some of the new stuff then we'll take our time and make sure that we understand it. So paragraph number 1 tells us all about sales. It says that 40% of the sales are for cash. That means immediately in the month that you are selling, you get paid, and 60% of sales are on credit and are collected 1 month after sale. So you guys should already have your page set up, having paused the video, but you can see here that we've got cash sales and we've got credit sales. I've actually left the credit sales 2 months in here, just so you can see the difference in the two questions, but we're not going to use this. Instead, we're going to use this here, and all of these numbers are going to be 40% across the board. So on your calculator, you can do 42,000 by 40%. And that's going to get you your number there, and so we transfer across and across and across. So therefore your calculator will help you with this, but this is 16,800. This is 21,600. In fact, there's a slightly different way I'm going to do this. I'm just going to show you, this is your 40% here, and then your 60% is going to be down here. This is 25,200. And these two numbers, let's get rid of this for a moment. These two numbers, of course, still add to the 42,000, which is January sales. It's just that it is staggered 1 month, 40% for cash, 60% 1 month later. No discount in this question, which is a little bit easier than we've had. Let's do February there. Well, that's 21,600, and then 32,400. March, and even 20,000 for the 40% figure, and then 30,000. That's based on the 50,000 sales in March. April, 18,400, 27,600. May, 19,200, and 28,800. And then of course you have June, and you have June is 20,000. And it would have been 30,000 down here, but of course we don't have July's cog in here. One number we need to go back and fill out here. What were the credit sales 1 month later that we received in January? Well, that would have been the sales that we made in the previous December, and you're given that number as debtors of 9,000 at the start of the year. The question tells you how much the debtors are at the start of the year. So therefore, that is your total credit sales for January, what you sold in December. That's all of the sales done. So as you can see, we don't need this 2 months at all. I just wanted to leave that in to demonstrate the similarity or the difference. But now we can go on down to purchases. Now purchases, there are a couple of sentences, and all the sentences are numbered in this question. There are a couple of sentences which refer to purchases. The first one is sentence number 5. It says all purchases should be sufficient to cover the following month's sales. So therefore, what that means is what you buy in January should be enough to cover your sales in February, the following month. The company always wants to keep enough stuff in stock to cover the following month's sales. However, we also need to consider sentence 2, where it says gross profit as a percentage of sales is 25%. So if the gross profit is 25%, 100%, here's our 25%. In here, the purchases must be, or at least the cost of sales must be the 75%, the difference between the gross profit and the sales number. So therefore, what we're going to do here is we're going to take each purchases, I'm just going to write it here, is 75% of following month's sales. And we're going to do that for each month. And that's because of the cost, the profit being 25%, the cost of sales or the purchases is 75%. And it is of the following month. And one more sentence in the question to make this clear. Sentence 6, it says purchases are paid for by the end of the month. So in this case, there is no credit purchases. You pay for it in the month that you buy it. So therefore, what is January's purchase? Well, it is 75% of February sales, which is 54,000. So therefore, 54,000 multiplied by 75%. On your calculators, that is going to be 40,500 goes in here. 40,500. What is February's purchases? Well, it's going to be 75% of March's sales, which is 37,500. Hopefully we can see this pattern now. Then March's purchases are going to be 75% of April's sales. April's purchases are 75% of May's sales. May's purchases are 75% of June's sales. And finally, what are June's purchases? Well, this is why they gave us the July sales. So it is 58,000, a number which we haven't used before. That's July's sales by 0.75 or 75%. And that's going to give you that 43,500. So purchases are 75% of the following month's sales. Now let's look at some of these other things now. Paragraph number, I've done these in a particular order, but it doesn't really matter what order you do them in as long as you get them all in. So paragraph number 9 says about wages. It says it's 6,200 per month. So that's just 6,200, and you literally just put that across the board. We've seen that before. Rates is paragraph number 11. It says rates for the 6 months from the 1st of April, and it's paid in April, is 800. Now that's easy in the cash budget. There is going to be a prepayment amount when we get to part B of the question. But in the cash budget, that's just 800 in April. Rent, it tells you that rent is 18,000 per annum and it's payable each month. Well, we've done that before. 18,000 divided by 12. That's going to be 1,500 each month. And we're going to, excuse me, we're going to replicate that across here, 1,500 each month. Now, then we've got the purchase of a computer. Look at paragraph number 10. It says a computer was purchased for cash on the 1st of March for €1,600. £1,600 as it says. And then there's depreciation. Now we know that depreciation is a non-cash expense. We don't deal with that until Part B, but we can put the 1,600 expense into March. We had to pay for that thing. Likewise, we have machinery, and I'm going back to paragraph 7 here, and it was bought on the 1st of February for 8,000. So we go back to February and we go 8,000. And we're straightforward on that. Now, at this point, the question gets a little bit more complicated because we have a loan here, and that's going to refer to another part of the question. But I'm going to stop the video here, and I'm going to pick that up in the next video. So we're going to get this much done, and then we're going to come back and explore how we can finish this question off.